Hello, I'm Peter Switzer. Welcome to the program that helps you make the absolute most of your money. It says you've got to be wary of traps. So what in the hell are value traps? Stock expert and Roger Montgomery, generally an expert on everything, joins me now in the studio. Value traps. This is the subject I want to talk about. Define them. Okay, well,
a value trap is pretty simple to understand. You think it's cheap, but it's going to get even cheaper. So share price has dropped a long way.
It's like Centro.
Centro or ABC Learning Centres or
Babcock and Brown.
Babcock and Brown. So it's fallen from $30 to $5 and it appears to be good value, but it isn't. Now, what are the various solutions? So some fund managers, I obviously know a lot of fund managers in my field, and I've asked this question, what do you see as a value trap and how do you spot the difference? And so some of the things I've heard is have a look at margins. So have a look at profit margins. If analysts are so share price has gone down, we'll put that aside. In all scenarios that I'm about to give you, the share price has dropped a lot. Yeah. That's what we're trying to work out if something's good value.
Some people might call it, wouldn't they?
Yeah, I think someone the other day said to me, it moved adversely, an adverse price movement. I think they called it an adverse price movement.
To go up.
Yeah, okay. That's right. So one thing to look for is, for example, profit margins. Are analysts forecasting greater profit margins than have been presented by the company or produced by the company in the recent past? And what that can mean is that analysts are being optimistic with their forecasts, and so while it might look cheap on a PE basis, for example, or on an earnings expectations basis, it isn't, because the company in the past has demonstrated no ability to generate the sort of profit margins that the analysts are forecasting. So that's one example. Another example is where earnings expectations are falling and the share price, so analysts are lowering their earnings expectations, at the same time the share price is dropping by more than the market. So that's another example that someone has told me that's what they believe signals a value trap. I don't like that one. I disagree with that one because I actually think that whether analysts are lowering their expectations or not may have an impact on the share price, but it still may be good value, even though the share price has been dropping more than the market. I understand that the best defence against a value trap is experience and an understanding of the business. It's as simple as that. And what you need to separate is the price and the business. So a value trap is where the fundamentals of the business are deteriorating as well as the price. That's a value trap. You don't want to be invested in those sorts of businesses.
Give us a classic example of a company now that you think is a value trap.
Look, anything that's a C5, I think that businesses that are C5s, and there's plenty of them, a business like Lease is potentially a value trap. Now, its share price will go up in a market like today. Why did it go up? It goes up because, quite frankly, there's not that many great businesses in Australia to buy, and fund managers are bereft of choice. There's simply not many good companies to own in Australia, and if you've got a mandate to manage $1 billion or $2 billion, and you're a relative value manager, and it's a very sensible business strategy to be relative value, because you've got to be fully invested all the time. Research houses and dealer groups they make the decision about how much to invest in cash and how much to invest in shares. So they want their fund managers to be fully invested in the market. So if you're going to be fully invested in the market as a fund manager, it's better to be in a relative value. So I'm finding that the things that are relatively the cheapest but aren't necessarily cheaper than intrinsic value. And there's not many companies that produce a profit in Australia. Out of 2,083 companies, 1,176 made no money last financial year. So there's a very small universe of stocks to pick, and if you can only invest in big caps, well, there's even fewer. So Lease will go up on a day like today just because people have got to buy something. There aren't that many good companies.
What about Macquarie? Macquarie's ones a lot of people have held. Their price has fallen.
Well, the price has fallen a lot. The question is, has the fundamentals of the business deteriorated? It isn't the business it was 5 years ago. It isn't.
But you and I would agree with that. Close to $100,
and the share price was $100. Yeah. So I prefer to find businesses where the business hasn't deteriorated, but the share price has fallen. So Woolworths is a classic example of that. The share price has gone sideways. Well, it hasn't fallen, but it's gone sideways since 2007. Right? I think it was $36 in 2007. It's $10 lower than that now. and yet the value of the business has been rising steadily since that time.
Yep.
So that's an example where it isn't a value trap, it's actually potentially very good value. So we own Woolworths for that very reason.
So can I go back to Macquarie? Is this a company that isn't, would you call it a value trap, or is this a company that if America recovers strongly, Macquarie will recover? I'd
like to buy it at a much bigger discount to its intrinsic value. My concern for that particular business is actually staff morale more than anything else. There's a lot of Macquarie Bank CVs floating around the job space, and that tells me that they're not happy where they are. And that's the business. Macquarie Bank is its intellect and the people that are carrying those brains. And so, quite frankly, I think that's the big issue for the bank. It's whether or not those people stay there. And I think that's a fundamental problem. And there are just easier things to invest in.
Are there other value trap companies you could talk to us about?
Look, I think businesses like Asiano, potentially a value trap. Leighton's at the moment, potentially a value trap. Why do I say that? Because I still think it's got big issues in Dubai with the... I think it's got issues in Dubai. I think it's got issues with the desal plant in Victoria. They're not going to go away in a hurry. And as we've seen in the news recently, and I talked about it on your program many weeks ago, they've still got issues in Queensland with the airport link. Those things are going to impact the potential for their profit of $600 million that they're forecasting for this financial year, and so I think it's potentially a value trap.
What about transport services?
That's a classic example of a business that has been described by many as a blue chip, but I rank it with Qantas in terms of its business performance. They make acquisitions that are overpriced, they generate low rates of return on equity, high levels of debt, low rates of return on equity. It's just a business that for me is not investment grade. And if you look at their share price today is, I don't think, very, very much changed in the last 7 or 10 years.
Yeah, I think it has gone up since it announced the 10% buyback.
Okay, well that may be true, but if you're buying back shares,
the market actually supported the company.
If the value of the shares, if the value of a company's shares is $1 and you are buying back shares at $10, you aren't adding value for your remaining shareholders. You may be artificially supporting the price, but ultimately value is going to drive the share price.
Okay. Other companies that fit into like the Woolworths category.
Yeah, okay.
Its price is falling. Its price is falling, but it's not. It's the opposite of a value.
Well, it may be that their price hasn't fallen. Okay, so businesses where value's rising and the share price has been going down recently. Companies like Forge, Decmil, Woolworths. Some of the gold stocks, even Troy Resources and Silver Lake Resources. There's ARB, another example, hasn't gone down that much. Reese, Cochlear, CSL. These are businesses that have fallen in price, but their fundamentals haven't deteriorated. Their fundamentals long-term are fantastic. They've got great competitive advantages. They're leading their particular sector. Great margins, low debt, high rates of return on equity. The opposite of the value trap type businesses.
Okay, so if someone is looking at a company that has the classic characteristics of a value trap.
Really simple, really simple. Share price has gone down a lot.
Yep.
Could this be a value trap? Look at the fundamentals of the business. Don't worry about what people are saying about the company, because that is often as much a function of sentiment as it is the performance of the business. So separate the price from the quality of the business. We know the price is down, that's why we're assessing it on a value trap basis. Put that aside. Have the fundamentals of the business declined? Now, I've talked before about intrinsic value and looking for businesses whose intrinsic value is going up. Yeah. So we're looking for businesses where the fundamentals of the business are improving. Do I think this business has a high rate of return on equity that can be sustained? Does it have little or no debt, so a high quality balance sheet? That's going to be a defence. Do I think margins are improving? Is this company winning market share over its competitors? JB Hi-Fi, classic example. It's buying market share from Harvey Norman and Jerry Harvey in a difficult, admittedly difficult retail environment, but it's winning market share.
Hey Roger, thanks for joining us as always.
It's a pleasure, Peter.
Terrific.